Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 28th of May, 2020. And what you're looking at here is the S&P, or the SPX, S&P 500, closing exactly at the weekly expected move. We've seen this script before, which happened last week. And the blue line is Don's hand calculation of the weekly expected move, which is a little bit different, just a little bit less than it's actually 3027. And it's just a couple of ticks shy of the auto-generated expected move. So just keep that in mind, that we're going off of the 3027 weekly expected move. And that's roughly where the market closed in today's session. What's most notable, I think, about today's session, we'll take it to the SPX and look at that on the S&P 500, just to look at that weekly expected move, is that we skirted under it, I guess, last week really, traded up to it in yesterday's session, came down away, and what's Wednesday, came back and pushed through it, almost like a miracle, as the market looked like it was going to fall apart, but instead closed roughly at that weekly expected move. And in today's session, a round of short covering, short squeeze, liquidation of the bear positions, some of the tighter held stops, really across the board, helped create a trend type of up morning where just about anything was successful on the long side. And that little surprise type of news, but you can see the tech and anything else with volume or momentum, that the market pulled right back, all the way back to the weekly expected move. And it's no different. I won't spend the video talking too much about it. We've discussed it last couple of sessions, but we'll pull back to the hourly chart. And a lot of charts, or a lot of lines on this chart, will actually simplify it by looking at the SPY and see where our mind is. When the profile, this is your volume profile, just like a standard distribution or bell curve. This is the mean or the midpoint or the average. Think of it like a gravity point that pulls the market to it, or a rubber band, where you attach a rubber band, and when you get too far away from it, the rubber band snaps right back to it. And the market's like that right now. So I know the market didn't pull back last week, and so we got to push above. We're still of that same type of mindset, that either we launch, the rubber band breaks, and the market surges straight up. Felt that way this morning. And we go up the Friday and into next week, or like the probabilities, we're going to pull right back in. The Nasdaq already completed part of it with a pullback or retracement back inside the profile. And we can look at some of the tech names, which does include Netflix. If you're curious, this is exactly what we say should have happened on the broader market. It just took place within the Nasdaq index, some of the tech stocks. And again, Netflix is part of it when the market is above either the weekly expected move, a probability distribution curve, or what I look at, the volume profile. That tends to put the odds in favor of the bear or the sell side case. And for trade tactics or in-out spreads, verticals, or just purchasing puts, we're looking to play a put purchase into or above, or I guess if you're being really precise, on the return back inside of this value area extreme. That's roughly $4.50 per share in Netflix. And you're targeting, you can spread out the other side of the spread, or just cover the put either at the midpoint, that's roughly 430, or down at the yellow line, which is about 415. So that's how it's supposed to work. Certainly doesn't always do that, because trading is a probability game. Other tech stocks that were weak earlier, they played right alongside. So Amazon was one of those that had a little push above. It's just mean reversion, playing back to the mean, playing back to the average, shorting at a market that is overbought, covering at a market that becomes oversold, or test out lower levels. Now that's the Nasdaq. That's your big tech names. Other ones did too. We could take a look at Facebook, that is pushing back inside the profile. Microsoft, which got all the way down here. And I think this is where I want to focus your attention as a trader who might be new to this type of planning. It is like the weekly expected move. It is all probability, but there is an edge when the market's above the yellow to come back inside, when it's beneath the yellow to come back in, and that's just a standard distribution bell curve. not too dissimilar from our weekly expected moves. Usually the market will stay within it, but sometimes it doesn't. And if it doesn't, things can get wild. Things get out of hand. Of course, that was earlier in February. Now, that's the main idea. That's not changing in terms of the plan. Let's pull the perspective back a little bit to other markets outside the S&P. And we'll start with crude oil. Well, there was a lot of activity in crude oil, really from 65 per barrel all the way down to $5. Yes, that printed. If you remember, it printed negative, at least the near-term expiration contract. This is the continual contract. And since then, since the chaos, crude oil has remarkably rallied. And that was very difficult to trade, so I understand if that was not on your radar of things to trade on the intraday or the swing perspective. So we'll jump away from crude oil right now and continue talking about gold. Gold had a buy opportunity, a bull type of flag breakout trade just recently, and that came back to the breakout spot, and that's roughly $1,700 per share in gold. If you do not trade gold itself, you can take a look at GLD, which also gave a short-term buy signal. That pivot point for GLD, our ETF, is roughly 160 per share. And again, we can see how that led to higher highs. And instead of just jumping long into a breakout market or trending market, I recommend pullbacks, which we call retracements or flags, to a moving average or to the prior price high. On the other side, we have a relatively similar picture. Let me update our trend line here for the bond market. This again is the ETF, Exchange Traded Fund, TLT. That's just your longer term U.S. Treasury bonds. IEF would be your shorter term. And of course, you can look at this as a ZN or ZB futures contract. And I'll draw your attention in tonight's video to the potential of a breakdown. And let's just say a breakdown in bonds could be a bullish catalyst for the stock market. And again, that's bonds and stocks compete for capital. So if the market is to burst, if that rubber band snaps, right? Think about that. If that sort of hits you in the face, that's what the market might be doing. It's just a snap. In other words, gravity will give way and the market will levitate quite powerfully up through this 3,000 print where we are. Again, this week remains critical, very critical about what happens next. So if bonds do break down, and we're going to watch that very closely next week, that could lead or signal or take part with that breakout scenario. On the other hand, we still have support, we still have an uptrend, and these levels at the moment, as of this video, are holding. And that makes sense. If we're talking about a critical resistance point, right, if the market breaks above, it's going to surge, we're probably looking at the same perspective or same level, but as a support shelf. And that's what we're seeing in the bond market. And for TLT, that's just above 161, almost 162 per share. So we'll keep watching these names very closely, specifically if, I think about it almost as a, I know that's your gravity points, that's the weekly expected move and some moving averages. It's a lot. That's why I might want to just look at the SPX, just for clarity's sake. And that is here. So think about that, just as a counter perspective. Bonds are at support and could break lower. If they do, that means the equity market probably breaks much higher. And of course, if bonds hold support, hold the uptrend, we might see equity markets pull back. But you don't need me to throw one more voice out there in the bearish type of environment, or at least making a bear case. Be neutral, watch the levels, manage positions, take stops as necessary. But despite if this market does break up, break to the upside, remember probabilities work, but something that has a 25 or 10% or 15% chance of happening actually can happen. And we may be seeing that take place in the next week. And specifically, that is a upside break into this open air pocket or open air zone that could push the market much, much, much higher. That's where our focal point and positions and stops and everything else are trained on these levels. We don't know the future. All we can do is plan and adjust. As always, be careful and safe. This is Corey Rosenblum with your Theo Nightly Video for May 28th, 2020.